take up pleasure.
Okay, so I have your quizzes graded, but I had to make some arrangements for students, so we're not going to get them back today, but we'll get them back on Wednesday and we'll go over them in class. The high score was 100%.
Cool. Okay.
The low score was 23%. And the average was 68%. So you are somewhere in that range. And that's the average. So, some of you have some work to do. So we'll just get right back to work here. And we will go over the exam in detail on Wednesday. So you'll have a chance to see it and work through it. Okay, any questions?
No, I mean, I thought he was doing like...
Alright, so we are going to jump on the other side of the island today and investigate businesses. So this last material, especially Chapter 8, was primarily concerned with consumers and households and beer and pizza and stuff like that. So now we're going to focus in on the firms. So we've got our market system, and we've spent most of our time in the output market, right? Supply and demand of pizza and beer, that sort of thing. And we've also talked about resources. So the idea here is that the households own all of the resources, land, labor, capital, entrepreneurship. They sell it to collections of people that organize themselves in the form of a firm during the day so that they can bring home some bacon and buy some things at retail stores, right? So that's kind of our flow of the market economy. And so we're going to talk about these collection of people for almost the rest of the whole semester, but especially the next 5 chapters are all going to be centered around firms and their decisions on what they're trying to maximize. And what are they trying to maximize? Profit. All right, so we could kind of generally call this the theory of the firm. In other words, we're just looking at businesses. And our primary assumption is that they are out to maximize profit. But I want to step back from that a little bit because, you know, profits get a bad rap, and it's really unfortunate that they do because they provide so much to everybody everywhere that I want to step back from that and go back to the chapter we just came out of. What were the households trying to maximize? Utility, right? So they were trying to maximize happiness. And so now if you start to think about a fraction of these folks being over here during the course of the day, we're really back to utility maximization. And so part of the way that you make yourself as happy as possible is you figure out what you're good at and you specialize it over here to maximize profit, but that's really an intermediate step, right? It's what you do with that income from your resource base. What did you do with your scarce resources? When you came back, now you've got opportunity to maximize happiness. And so that's all really one and part of the same, but somehow the general public, I think, starts to split those things out, that they're different from each other, when really it's all about utility maximization, in my opinion. And this just helps us think about the various elements in a different way. All right, so they are out to maximize profit. Now we've done the profit equation a little bit. What is profit? Again, I'm going to use the little symbol pi here to denote profit. What is profit? What is profit? Total revenue minus, not price, cost. Total cost. So total revenue minus total cost. We've written it out a couple different times. Now let me come back to you on that price thing. What is total revenue? Price times quantity. Good. So we do have that price times quantity, the quantity that was produced by the business. If we're running a lemonade stand, the number of glasses of lemonade times the price that the lemonade was sold at gives us the total amount of money in the cash register. Now, we spent a little bit of time on that with the demand curve and the total revenue function, and we thought about the amount of sales receipts, because what people are spending up here, the total amount of spending by households, equals the amount of revenue collected by the firm. So they're kind of one and the same. The total amount of spending equals the amount of revenue now for the company. And what we haven't spent as much time on is this total cost. And really, this whole part of the chapter 10 and 11 centers around cost. So we're going to kind of park this idea for a little bit and focus mostly on the cost side, especially in chapter 11. Okay, so I think we'll get into this by thinking about a little story here. Before we do, I want to think about a breakdown of costs. So let's kind of break this down into a couple components. So we've got monetary and non-monetary cost. Monetary and non-monetary costs. What the heck do we mean by that? Well, the monetary costs are the things we usually glom onto. If I'm hiring 10 hours of labor and spending $7 an hour on these people, it's going to run me $70 worth of costs. If I buy some steel, and steel's running $50 a ton, and I buy 6 tons, then it's 6 times 50 is the cost of the steel that went into the golf club, right? So all of those are what we call accounting costs. And this is where econ and accounting have a little bit of a departure from each other in most cases, although we've seen some things here, I'd say in the last 10 years where I think accountants and economists are coming together in some ways. All right, so I want to think about our total cost being the sum of explicit cost and implicit cost. Explicit cost and implicit cost. And these have open today. So the explicit costs are the monetary ones. Very easy. If something's explicit, it's easy to see, right? So these are going to be kind of accounting costs, if you will. Kind of easy to see because there's a price tag on them. While implicit costs are a little bit harder to see because there's not a price tag that the market tells us what they are. So this is what I call economic art. You know, some people call economists scientists, and I think this is one part where we're more of an artist. We have to kind of estimate and create and think about what our implicit costs of doing something are. Okay, and so this gets to the heart of your opportunity cost. So what was our running definition of opportunity cost that we hopefully knew for the last test? Who wants to take a stab at that? Opportunity cost.
It's the price of manufacturing a good plus the essential benefit of anything else we could have been doing with our resources.
Okay, yeah, I want to kind of run with you on that more, is that kind of what we could have done if we weren't doing what we did, right? So what are your other opportunities that you gave up? Now, opportunity cost is truly both of these things, but the things that have a price tag on them that are easy to see, those are easy to see what your other opportunities were. In other words, if I spent $70 on labor, I gave up $70 of something else I could have got, right? So that part is kind of easy to see. Whereas the implicit cost could be, well, if I wasn't here, I'd be home caring for my 3-year-old baby and playing with it. Oh, well, what's that worth to you? Wow. It'd be fun, it'd be nice. Well, that's a cost that is implicit in the decision to do what you did, but doesn't have an easy price tag with it, right? So opportunity costs are truly the sum of these two things. So opportunity cost is what economists refer to. Monetary and non-monetary cost. That is your full-blown opportunity cost. Monetary cost and non-monetary cost. Okay, so let's jump into a little example here. Let's see. Make sure I got this thing lined up here. I wish I had my little gizmo to track this a little better. I guess I'm going to write it here. For example, suppose an English professor decides to open a restaurant. All right. Let's see. What should our English professor call his restaurant? Give me a name. Any name. Restaurant. What is the name of our English professor's restaurant? Sean. Give me a name of the English professor's restaurant. I know pressure's on. You can do it. Push, dig down deep. Shakespeare's Plate. Wow, that's awesome. All right, Shakespeare's Plate. Wow, that's really good. That might be the best. I think that's worth an extra credit point. That's like the best name that I've ever heard in the 20 years I've been doing this for the restaurant. All right. Shakespeare's Plate. All right. So, here's some details. So, currently the professor was working at OU, making $60,000. So, currently he teaches at OU, making $60,000 a year. Okay, so here are some other costs that he has. He gets a building downtown in Ottawa, and maybe some other equipment came with it, and he's going to shell out $50,000 a year for rent and other related things like that. And of course, he's got grills and coolers and all the other restaurant equipment, deep fryers. Going to run $200,000 a year for all of the other related things to the restaurant. And then of course has to go out and get some cooks, some wait staff, some dishwashers, all of that type of stuff. It's going to run $110,000 per year. And then lastly, the ex-professor is going to manage the place. Ex-prof will manage so that he does not have to pay, the market rate for a manager. The market rate for a manager of $35,000 per year. Okay, so my question to kick us off is that if the restaurant pulls in $400,000, if total revenue is equal to $400,000 per year, what are profits? What is profit for the profit? Profit for the profit. All right, so what do you think? Why don't you all take a minute, turn to your neighbor, and come up with a number. I'll walk around and see how you're doing. You got the basic equation on the board. No, he's no longer working at the college.
The profits go in his pocket. So that's how much he's making. Minus all that. And then the opportunity cost of not being a professor is $60,000. Where is a profit? Does that mean?
All right, shoot me out some answers.
So he was actually making
What do you got? Let me have it. Give me a number.
Minus 10,000.
Minus 10. Any other answers? Minus 20.
Is he still?
No, he's not a professor.
I was gonna say.
He's an expert.
What else? Any other thing? You got 40? 40,000.
Then you subtract the how much.
Okay, anything else? You say yeah to that? Any other ones? All right, so we got multiple answers. If you were seriously the professor and you were thinking about how much money you made, what would you say? If you were really, put yourself in the professor's shoes, what would you say you're making?
400,000.
40? Yeah, and possibly 400. I've heard people say that. They get kind of confused between revenue and revenue and cost. So 40,000, right? How much does he get to go to the marketplace with? Let's put it that way, to put diapers on the baby and all that kind of stuff. What's he got?
That'd be 40,000.
40,000. Okay, so 40,000 sounds pretty good. We got negative 20 and negative 10. What's that all about?
Because it's 40,000 is less than what he was making at his professorship job.
Okay.
He's working more hours as a restaurant manager than he is as a professor.
Probably, but we don't want to work more into it. We kind of want to work with the data that's here and the assumptions that we have. So, but you're probably right. Yes, that's pretty standard for most small businesses working themselves to the bone. So where did the negative 10 come from?
That was my assumption that he has lost time, basically.
Lost time. So tell me the numbers. So we got 400,000.
So once all the accounting stuff is off, he's left with 40,000.
Okay.
With an assumption.
So hold on, let's do that part then first. The 40,000 comes from, because that's where other people were getting 40, right? Just so we're clear. We got 250, 110 gives us 360,000. 400 minus 360 equals 400, right? So we kind of got that going. And then to get to a negative 10, what else did you do?
Well, after all the accounting costs, he had 40,000 with the assumption that the benefit of that 40,000 is the 35 that he did not have to pay a manager but minus the 60,000 that he would have received as a professor.
So talk to me equation goggles. What am I subtracting?
So subtracting the 60.
Subtract the 60, okay? Is that it? So this equals negative 20. So that's this number. Okay, I just want to make sure. Did the 10, did you take off another, or a 10 less for something else? Or was it just meant to be this?
There was a gain in non-material gain of the 35,000 he would have paid a manager. So then I just rounded it.
Okay, so this ends up being negative 20,000. And then you did a little rounding trying to factor in the manager somehow.
Yeah.
So if we go back to do our taxes, is the professor able to, those of you who put the negative 20 or possibly the negative 10, does the IRS allow you to take a $20,000 loss and actually reap the benefit of that you don't have to pay taxes?
Yeah, you can take a loss.
You can. Are they going to allow this deduction? The IRS can allow you to write off your salary that you could have made had you stayed a professor. No, no way. That'll put you in some jail or penalties or something for if you get pulled for an audit. So that's not going to fly there. So how did you factor in the 35, or does the 35 make sense? Is that allowed by law? What if we do the 400 minus the 360 that we all agree on, minus the 35? Is it okay for him to pay himself 35?
But then that's just two separate salaries that still add up to 40,000.
Okay, so this number ends up equaling what?
That's 5,000.
5,000. Okay. Now, does this help out the situation at all? I mean, does this make something more transparent, or does it just muddy the water? Does this tell a story for you at all differently than what we've done with the other two calculations? I guess I didn't put the 40,000 was just simply the 400 minus the 360.
Tells us not hiring that manager was probably a good call.
Not hiring the manager was a good call or bad call?
I'd say a good call.
A good call. Because why?
Because it's hard to live off $5,000 a year.
Okay, because we would have only had 5. Okay? So what does the 5 represent that's different than the 40? So everybody agree that the 40 is how much the professor in his mind is like, okay, I got 40. What does this do? I think you're touching on it, Cora. Anybody else want to jump in here? 5,000 is the profit for what? What would that maybe better reflect? The profit for what? The owner of the business, who may or may not be the same person, right? So it's kind of reflecting the profits of the business a little bit better. And maybe there's some tax advantages or something. So maybe the accountant wanted him to do it this way, and he's like, whatever, you do your hocus pocus accounting books. All I know is I have 5 plus 35 gives me 40, and that's how I calculated it in the first place, right? So I have 40 at the end of the day. All right, so the accountant or the IRS or somebody else might have us do the books here, and it does kind of help if we think about the accounting this way, because now we've got the business identified as earning $5,000. It's possible that the government taxes this 5 at a different rate than they tax the 35. Who knows? But it kind of gives us a reflection of the business. All right, so what does this one add then? Is this even real, the negative 20? What does that add to the picture?
It's opportunity cost.
Okay, you got opportunities. And so what's it signaling? Let me go to somebody else. What does this signal to the professor? What kind of signal is it sending? You should have kept another job. That's right. And that's an important signal. I like to call it the signal of you suck. You suck. You suck. Right? Go do something else. What? My opportunity cost. Why? Because it's already factored in right there. Right? Go do your alternative and you could be made better off because we have your alternative already embodied in the equation. So economists are looking for profits to act like a signal to the market. And that's what this 20 gives us. So this is called economic profit. This would be maybe accounting profit. And this would probably be the English professor's version of profit. So this is the English prof's version of profit. The point is that none of them are really wrong. It just depends on the context. Although I might argue that this is the most right of them all. But that's a different story. I might be a little biased, right? So economic profit includes some costs that are implicit rather than explicit. So the implicit costs end up being a determining factor on maybe what the prof should be doing or shouldn't be doing. All right, so let's bump up revenues to 420. So let's take a different stab at this. And so example number 2, everything's kind of the same except for, let's say total revenue is equal to 420. Now, what is, maybe we should just do, yeah, let's do all three. I've never done this before. The English prof's version, the accountant's, and the econ version. English professor's making how much in his brain? 60, right? We went up by 20, he was making 40, now he's making 60. Accountant. 0? 25, right. So we had 5 before, and now we'd have 25. And then finally the econ profit.
Now it's 0.
Now that one's Zippo.
It's a perfect trade. Now look at this.
All right, so now, my question would be, what's the signal going out?
Equal, it doesn't matter.
Doesn't matter, yeah, it's not you suck anymore. That harsh signal is now a little amber. It's possibly even a go because you can't do better elsewhere. So it's okay to keep doing what you're doing. Now, would we like to have more profit?
Yes.
Yes, go back to item number 2 over here, maybe item number 1. We are out to maximize profits. Our goal is not to have 0, but our goal is to make it as big as possible. But the point here is that if we measure profit this way, it's okay to be at 0. Whereas if your accounting profit or your English professor calculation of profit, if those are 0,
You got
it's
problems.
not so good. Yeah, you've got problems. Especially the English professor version, you know, you're going hungry. You've got no money left over to pay other things in life. So that is the value of including opportunity cost into your calculation of profit. All right, so this is okay because we can't do better elsewhere. Since all implicit and explicit butchering up explicit costs are included. Okay, now, one last one. Example number 3. Suppose that total revenue jumps up to, I don't know, 460.
Nice.
Let's let that English professor have some fun. Now, I'm not going to do the other 2, because hopefully you're starting to get the picture, but I do want to do the economic profit. So economic profit is now what?
40,000.
40,000. So we've got $40,000. We were at 0 before. We added another 40 on to revenue, so that ramped us up to 40,000. Now, how does the English professor interpret the signal?
You done good.
Now, how do other people interpret the signal?
You're short for maximizing profit.
Oh,
You done good.
Yeah, I got that part. What else might they be thinking to themselves?
I could do it too.
I could do it too. If just an English professor's out there making money at this business, well, geez, I'm an engineer. I'm an economist. I know how to really calculate numbers. Imagine what I could be doing if I entered the market now, right? So that's how profits are going to be a signal. When economic profits are less than 0, the you suck signal's out, and that means the English professor should
Go back.
Exit, get out of that business and go do something else. The market is telling you that you have opportunities that are greater than what you're putting in to run this restaurant into the ground. So he exits, right? Now what about when the 0 signal's out?
Do what you like.
Yeah, he's okay staying. Is it really putting out a heavy scent out to the market to come wafting in and enter and open up a restaurant if he's just earning a 0 profit? No, right? So that kind of puts the brakes on the temptation for other companies to enter the market. So that's how these profits are going to be signals, and they're important ones. So when economic profits are 0, the professor's still earning a profit, but we're going to call it a normal profit. We kind of talked about this a little bit with the butcher, the brewer, and the baker with Adam Smith. And we thought, well, what would cause them to enter the market and start doing it? Well, if they're earning abnormal profits, if the profits are abnormally high, that are above and beyond what the resources that are being devoted to it are really worth, then I should do it. I want some of those abnormal free money, so to speak, or easy money. And what did we learn from chapter 3 that'll happen to the price of meals, if we're talking about a restaurant, as more and more places open up? What happens when there's competition? What's going to happen to the menu prices potentially for the professor as more and more pizza places open up in Ottawa? Is that going to put upward pressure on price or downward pressure? Downward. It's like, where'd all my business go? Oh, I know. People just need to get to know me a little bit better. I'm going to put an ad in the paper with a coupon. I'm going to do a Groupon. I'm going to do this, right? Effectively putting downward pressure on the prices. So that's going to bring downward pressure on the prices, which is going to lead to downward pressure on total revenue. It's going to start to come down with prices falling. How far are they going to fall? Until they get back to normal. That's the concept that we're setting up as we move into, actually this won't be till chapter 12, but I'm kind of planting the seed now of thinking about profits being a signal. All right, questions or comments on that? I'm going to write a few more things on the board for takeaways from this. All right, so since we're in economics class, when you see profits or think about profits in here, unless otherwise stated, you can assume that we are talking about full opportunity costs with both implicit and explicit costs included. So let's do some key points here. Since this is econ class and not Professor Wagner's accounting class, you can assume we are including implicit and explicit cost in total cost.
So when in doubt, go for the opportunity cost.
Yes, unless otherwise stated. So there'll be some problems in your homework and maybe on an exam that'll say, this is the accounting profit, or this is, it'll be pretty obvious, hopefully. So that's key point number 1. Key point number 2 would be think of profit as a signal, a beacon of light going out to the market for all to see. And economic profit greater than 0, that was our last case that we did, when it's positive, signals enter me. It's like the big light shining out. The flies come to the light. Come to me. All right. Economic profit equal to 0 signals nothing really. It signals that the industry or the person in the business is just earning a normal profit, which is okay, but maybe there's other industries that are just starting to grow, just starting to change. Maybe there's some places to look for something more.
Get in while the getting's good.
Yeah. And then economic profits less than 0. If that number turns out to be negative, you get the use up signal. Or maybe more tamely named exit. The exit signal. Time to get out. Okay, so let's do another example. Let's make sure we're all tracking here. Suppose our restaurant needs a new grill. Example number 2. Suppose the restaurant needs a new grill. I need an eraser. So the prop has been up and running, pretty successful, making that 420. Needs a new grill, and it costs $10,000. So after the professor talks to the grill supply company, he learns that there's a special promotion going on, that he can do no payments for a year at 10% interest. So no payments for a year. He's got enough cash, by the way. He's been doing pretty successfully, so he has some retained earnings. But those are used for operations, and it's kind of a safety net in case, the economy slips into recession. He's got enough money built up so that he can ride through the ups and downs of the business cycle. So the question is, pay cash or do the financing for 1 year at an interest rate of 10%.
Per...
One-time shot, 10%.
Okay.
And just to be clear, let's just say what what the total cost would be with the financing. So the total cost, or the marginal cost, I guess, but total cost of the grill with the financing is how much? 11. So we've got 10,000 is today's cash price of the grill plus the $1,000 worth of interest would lead to $11,000. So again, he's not cash strapped. He's got enough cash potentially on hand. Does he do the financing deal or does he pay cash? Pay cash?
Personal finance.
Depends on what you're more
Personal finance.
Dave
Drill.
Ramsey, pay cash.
Pay cash.
Got a few personal finance people in here that know what probably Dave Ramsey would say.
What's his preference? Give him the silent.
Right. Be prepared to walk away and make them let you pay $5,000.
Yeah, talk them down a little bit.
Fan it in front of their face.
So what is the price of the grill with cash, I guess is the question. So we got this equation. I think we hopefully all, everybody okay with this calculation, by the way? 10% on 10,000, 1,000, that's the interest payment, plus the 10,000 equals 11. What is the total cost of the grill when you pay cash? 10.
Like if something bad happens.
Now, does everybody agree with that?
Well, not if we factor in the non-monetary,
Like what?
what would he have to give up for that grill?
Okay. So you've got the cash, but this is the price today. When's this price? The way I characterize the problem. A year from now. So are those two things fair to compare? Oh, 10,000 is less than 11. Well, of course, Dave Ramsey says you got to do cash. You don't not listen to Dave Ramsey. Is that fair to compare those two things? No, it's not. So those of you who are still on your financial journey here, you can't compare things in two different time periods. It's not fair. They have to be in the same time period. This is in time period 0 today. This is in time period 1 next year. It's not fair to compare that 10 to that 11. So how can we make it fair? What would we need to do? Becky suggested something along the lines of including some implicit costs. Well, I want to be even a little more specific. Like what? Give me some ideas. Generate some thought here.
Isn't the 10,000 otherwise just in an emergency fund? So unless an emergency happens, it's not going anywhere.
We don't have enough information to determine that.
All right.
But you're right. I mean, that's a concept. Rachel?
Either the present value of the 11,000 or the future value of the 10,000.
Okay, so we need to bring this forward or this backward.
Right.
What are we going to use to do that? What do we use? Let's go with moving this forward. What would be the appropriate thing to move it forward with? We moved it forward with 10% here.
How much money are we going to make with the grill when we buy it?
No.
Oh, okay.
How much money will it gain interest in the bank?
Yes. How much more? Not necessarily the bank, because again, that's reading more into the problem than we know. But what are my other opportunities that I'm giving up by getting it? We don't have the same answer for everybody. That might depend on your situation. How you derive the implicit cost depends on what the English professor is doing, right? Even his story, he might have been making 60, but another person opening up a restaurant might have been making 45. Or another person opening a restaurant might have been making 110,000. It's situational. The implicit cost is economic art. That is, depends on the situation. We're going to customize a solution depending on the situation. So what we need to add on here is the opportunity cost, which is the implicit and or explicit, but we're really focusing in on the implicit part here. What would we have earned on the 10,000 had we not done what we did? Now, one sec. How is your answer going to change? Should you do cash or should you do the financing?
Cash.
What will it depend on?
What
Your opportunity cost. Right. Corbin.
Okay. So if we're implying an opportunity cost and not looking at the strict accounting cost, then shouldn't we also examine the cost of essentially waiting a year to get the grill? Like, since we're obviously buying it because we need to replace the grill, isn't there a potential loss of revenue?
Right.
You decided that you kind of made that decision already, that you need the grill.
Naturally.
So that's a different decision.
Okay.
But I'm saying that that's an important one. It's a different decision. Now what we're doing, it's kind of like step A, step B. First decision, should I get the grill? Yeah, it's a freaking no-brainer. My grill just broke.
Right.
I need a new freaking grill. Or I close my restaurant. right? So let's make that a no-brainer. Now that I've committed to needing a new grill, should I do the financing? Should I do the cash?
Okay.
Each way along, we're making a different marginal decision, gathering the facts that are relevant to the decision at hand, and potentially customizing that solution. Now, you guys mentioned opportunity cost. Give me an example then of what the opportunity cost in percent form would need to be for you to say, I'm doing the financing.
It'd have to be it'd have to be over 10% to do the financing.
Okay? Does everybody agree with that? Okay, I'm going to put mute on you for a sec, Corbin. You're doing good, but I just want to get other people participating too. So, Jimmy, give me an example here of what it would take if it was a number, as Corbin said, greater than 12. Give me a percent greater than 10. I'm sorry, not greater than 12, greater than 10. Give me a number greater than 10. 12. Okay? So if his opportunity cost was 12%, what is this number now here? If it's 12%, what is the opportunity cost of the 10? $1,200. I'm not trying to trick you. So that would be $1,200. And the total cost of the grill would be $11,200. Now we've got apples and apples in time period 1, right? I've kind of lined up the time periods. Which one's bigger? This one. What do we want, smaller or big? Small. We want small because this is the cost of the grill. So the overall cost of the grill is actually cheaper taking the financing plan because we had other opportunities. Now we can make this much more dramatic. I probably wouldn't do it at 200. But let's say you're thinking about doing an addition onto your restaurant or some other change, and so you perceive the opportunity cost to be 40%. You need to get at least 30% or 40%. Now all of a sudden that number becomes a lot more meaningful. It's like, oh yeah, let's do the financing. That's not a bad deal. Let's just delay that payment. We can do something in between in order to maximize profits. All right, so the linchpin here then was, first of all, the answer is depends on the opportunity cost. There is no right answer, right or wrong, without a little bit more information. So the answer is it depends on the opportunity cost. And so if your opportunity cost is greater than 10%, then we learned you should do the financing. Do the financing. If your opportunity cost is less than 10%, pay cash. If it's equal to 10, it's a coin flip. You can do what you want, but from a financial standpoint, it'd be a coin flip. Now, with a coin flip, by the way, I tend to look at which one has more uncertainty to it. Is it your opportunity cost? Is it this? You might start to do a little risk-reward trade-off and get in a little more detail, but that's the nuts and bolts of it. All right, we'll see you on Wednesday. We'll get the